February 15th. Yes, way to go, Abby. Our February 15th presentation. Tonight, we're going to be talking about cost segregation and just a few housekeeping items. First one is please send your questions during the presentation via chat to the chat box, and then Abby will be popping them in to us. We expect Robbie's presentation to be about 45 minutes. It'll be packed from stem to stern, a lot of information, some samples as well. This is really sometimes difficult information, but it's really cool. And we have a whole series of clients that have done very well taking advantage of cost segregation through cost segregation analysts. Oregon licensees will receive a CE credit. Please send your license number to Abby if you have not done so already. So we welcome you this evening, and I know you're buckled in for a wonderful ride. So moving forward to the next slide. Those of you that don't know, we had a merger between Bluestone and Hockley and Criteria Properties, and the combined company manages about 32 million square feet of commercial properties, 7,000 condominium units, 2,000 residential units in the Metro, Portland, Salem, Vancouver area. We have close to 100 employees, which is a local property management powerhouse. James Schaff is the president. Kristen Schaff is the executive vice president, and we're excited. And they also own SVN, obviously. Next slide. So what is Criteria Properties? It's a family business. The team of licensed real estate professionals was founded in 1985. And of course, the combined companies manage office buildings, retail centers, industrial buildings, medical buildings, multifamily, residential properties, as well as condominium associations. We work with individual owners, partnerships, trusts, and financial institutions and law firms. One of the things is we know what we are and we know what we're not, and we're not something for everybody. Our growth is measured to be thoughtful and careful, and we're definitely a thoughtful organization with very good accounting skills and very good staff behind the video, the Zoom screen. Bluestone Hockley, which is part of this equation, was managing over $2 billion in assets, which of course it's more now. The merged companies is more than that. And excuse me, somebody's trying to call me. And we manage from Portland Metro to down the Willamette Valley. Next slide. SVN is a brokerage company, sister company to Bluestone Hockley, and involved in transactions both in multifamily, retail, office, industrial, and hospitality in Oregon and Washington. And we also do some deals in California and other states that surround Oregon. We represent owners and tenants in the mid-market range from 500,000 to 2 million. And then Cost Segregation Authority, who's doing the presentation tonight, was established in 2006. They've completed about 15,000 studies, ranging from duplexes to mobile home parks and ski resorts. They provide an audit-ready report with tax court cases to support their findings. Their elite team ranges from multiple sales professionals and analysts, of course. They take pride in generating some of the most competitive results, while also providing new depreciation schedules for the owners and IRS Form 3115, which makes it easier for a CPA to do the tax return. Next slide. Is there another slide? Is that the last slide? It is, Abby?
So now it's
there it is. There's
bio.
Robbie. I was looking for it. I looked left and I looked right. Robbie Romero, who's our presenter tonight. Yay, Robbie, has been in the cost segregation industry for 5 years. He received his MBA from Westminster College in Salt Lake City. He has been directly involved in hundreds of studies and built solid relationships with dozens of CPAs across the Western United States. His constant traveling to provide continuing education to update clients so they can be in the know on this underappreciated and underestimated tax savings tool. It's a great tool. We look forward to today's seminar. Welcome any questions or conversations you might have. We talked about putting the questions in the chat. I also wanted to, and his slide is from him. Thank Bluestone Hockley for organizing, co-sponsoring. So without much further ado, hello, Whitney. Without much further ado, drum roll. Here we go on Robbie Romero and his presentation. And Abby is going to switch us over in just a second to his presentation. I believe, is that correct?
Yeah, I just stopped sharing. So Robbie, you're ready to go.
Robbie, you need to share and you're ready to go.
Yeah.
No, he's going to say, okay, I got to figure out how to share.
Yeah. No.
All right.
Yeah,
And
MBA,
I will
most bodacious associate or something, right? Not has nothing. If I can't figure out how to share my screen, right? So can you all see it then? Okay, great. All right. Well, I loved hearing Cliff speak more than myself, but I mean, who doesn't like to hear Cliff? So feel free to write down any questions you may have. I set a timer for about a half hour from now. I'm Mountain Time, so looks like I'm an hour ahead of a lot of people on here, but who we are. So just to kind of briefly go over who Cost Segregation Authority is, it was established with by a father-son team in 2006 and joined soon after joining forces with a CPA firm, whom we have since split off from and grown substantially since then, focusing solely on cost segregation and also some energy studies we do now. We have a solid team of over 30 CPAs, costing specialists, which sometimes we refer to as engineers, depending on the background, but it is a construction, essentially a construction costing job. And they do a great job at that. We have multiple sales professionals and operations support to get things rolling so that our studies can be ready for tax time. So we have completed studies in every state. Often I get the question, so can you only do this in my state for this client, et cetera? Well, we've done everything from multi-million-dollar mansions in the Hamptons and pineapple farms in Hawaii. So, and everything in between. I have apartments going on in Kansas right now. So as far as pricing goes, sometimes some of these things I like to knock out of the park before I get going here. They may arise, other questions will arise, but as far as pricing goes, we're competitive. However, we're not solely based on price. I mean, we offer a very deep report with lots of backing when it comes to the tax law and court cases that back up the benefit that we're providing the client. But we price competitively. Pricing, just to kind of throw just a general number out there. So we do residential rentals, which would start a little over $2,000, and then commercial buildings would go anywhere from $3,000 and beyond. The price does start to taper off as we've met kind of the minimum amount of work on the project. So the ROI usually becomes quite a bit bigger as you get into more expensive building because the price tapers off. So why cost segregation? So I'd like to, if I was in the room with you, I'd like to do a raise your hands thing. So I'm not sure exactly how many here are familiar with cost segregation, but essentially the main goal is to reduce tax lives. And by doing that, you're increasing the cash flow. The whole point behind cost segregation is to generate early tax savings and put money in the owner's pocket or the investor's pockets. So you're not necessarily generating more savings, but you're just generating it quicker instead of the building depreciating over a longer period of time. We're just depreciating it a lot faster and getting you money now. And I know, I'm sure many of you own your own property, so I think this is a great tool to be able to help you and or your clients. The third goal in cost segregation here is, I'm not going to dig too deep into it, but assisting in what's called repair regulation compliance. So I haven't really dug into the weeds here as far as cost segregation goes, but like I had a client today, actually, I was talking to on the phone, who is going to be doing a new roof on her house. And instead of depreciating the old roof and the new roof. If we do a cost segregation study, we're going to be able to include and cost that roof as part of the report. And so she'll be able to expense her old roof once she puts the new one on. Otherwise, she wouldn't have a cost for that if a study wasn't done and it wasn't broken out. So we're not able to accelerate the benefit on that roof or the HVAC, for example, because they're structural, but she's going to be able to receive that benefit by not having to capitalize both of them. And I'll dig a little deeper there later on. But cost segregation, in a nutshell, what the IRS lets you take and reclassify certain components in the building, and this is residential or commercial, from a 39 or 27.5 year recovery period down to 5, 7, or 15-year recovery periods. Just pushing your front loading that depreciation instead of waiting so long. You might not even own the building that long anyway. So again, it's about the time value of money. Every 100,000 reclassified results in approximately $16,000 in net present value savings. And I'll have some numbers to show you. A lot of this is wordy. That's just kind of what comes with doing a presentation, but it'll be interesting to see some of the numbers, and they kind of speak for themselves. So when we talk about accelerating the benefit, the depreciation, we're talking about section 1245 and 1250 property. So if you don't do a cost segregation study, the building that you buy is section 1250 property. And when we break it out, I'll just read it from here. So cost segregation studies, this is directly from the IRS. It says cost segregation studies are most commonly prepared for the allocation or reallocation of building costs to tangible personal property. A building termed 1250 property is generally non-residential real property, so your typical office building, or residential real property like an apartment complex. And it's property eligible for straight line depreciation. Equipment, furniture, and fixtures termed 1245 property, which is what we break out and segregate from the building, are tangible personal property. So we're basically taking it from just the structure and breaking it out to short-term, short-life property. And that's 5 or 7 years. So successful arguments to support what it is we can segregate from the building if tangible depreciable property can be removed. So this is kind of where it gets fun, and I can tell you some examples. You can kind of start picturing this. So if it can be removed without damage to the building structure, then it's personal property. So I often do a lot of studies in Phoenix and Vegas, Southern California, and I try to find out as much as I can before running a proposal, how much is tile. And more often than not, in a lot of those areas, much of the building is laid out with tile. And so you cannot segregate tile because you can't remove it without damaging the structure technically. So if a building has carpet or LVT, tongue and groove, linoleum type, you can segregate that. And so there's much more value when we do a study when we can find certain flooring. The relationship between the asset and equipment or machinery is so close they would be retired contemporaneously. So I think in that introduction, it had mentioned Deer Valley Ski Resort, who have done many different ski resorts. And when you have those snowmaking machines, you can see in the picture, there's a cement pad. So that cement pad is solely there to support the equipment. Same with the electrical and the plumbing that feed into it. If you remove the snow making equipment, that pad is only there for that. So you can take all those costs that go into the pad that supports it and the electrical and plumbing and segregate those along with it. So it's not necessarily structural per se. And the third one, the relationship between the asset and the nature of the business are unique. So we're talking if in a big data center, usually you only have fans or certain plumbing for the building itself, but because they are there solely for all of the electronics, all of the servers, etc., you can segregate those because they're not for the function and use of the building, of its what it's intended for, being a building. So grocery stores are an example of where we can generate lots of benefit. Doctors' offices, dental offices, medical, and manufacturing, for example, because there's a lot of electrical and plumbing and other cement pads inside of a manufacturing facility, things like that, that are there only to support the equipment, the short life assets. When can a study be performed? So when you acquire or purchase an existing building, when you build a new building, renovate, remodel, or expand. In fact, you don't even have to, well, with right here, make leasehold improvements, sell a property. I'll get to selling a property a little later on. There's a lot of benefit there that's overlooked. But what I was going to say, as far as if you don't even own the building, if you have a tenant that has done maybe $500,000 to $1 million, just kind of a range there, we can actually do a study, and we do them where they don't even own the building, but they've put so much in improvements that that a study is warranted, and we can generate the same type of benefit even though they don't own the cement and brick. So important court cases that help mold cost segregation. So these are some of the court cases. We have a court case for every component that we segregate in our report. We have a court case to back it up. So we can't just decide we want to segregate something if there's no backing on it. So our report is audit ready, and we're going to have a court case that determined that a certain asset was short life property instead of structural. We're going to have that for everything that we are able to segregate in the report. So Scott paper is one very important example, all the way back to 1980, before cost segregation is what we know it to be nowadays. That identified certain electrical components used to operate machinery. Without that, you'd be hard pressed to be able to pass it through an IRS auditor if you have certain electrical components in your building to say, no, this isn't part of the structure. So sometimes there are court cases for or against the asset. I've read various ones, even when it comes to like building structures, or parking structures. So parking structures are a part of the building, or even if it's next to the building, that you cannot segregate. And I'll get into some other examples here before I go on to this next slide. So I talked a little bit about flooring, but I just want to delve in for a minute into some of the other components that we segregate that qualify for short life. So if you can just picture your typical, let's just talk about like an office building. So we talked a little bit about some of the electrical, and then around the building are your 15-year assets, your land improvements. So sometimes we'll do a building that doesn't have a lot inside, a warehouse or warehouse/office, where there may not be many components inside, but on the outside you have all your curbing, you have your cement or asphalt, parking lights, sometimes even swimming pools, like for an apartment complex, for example, the trees, retaining walls, loading docks, shrubbery. So there's a lot of components, especially on the outside of a building, that you're able to actually segregate. They're not, the building can perform as a building without those. Now, bathrooms, you cannot segregate, even if it's a secondary or third bathroom for the building that maybe they added later. You cannot segregate bathrooms. You cannot segregate doors or windows, or the standard electrical for the building, for example, but blinds, cabinetry, countertops, electrical that goes to the disposal. If there's a break room, we can do most of the break room. So this just kind of gives you an idea. There's a long list, but a pretty good idea of things that we look at when we do a site visit when we do a site visit on each property. So the IRS does require that a site visit is performed, and most of the time that's in person, but sometimes it is virtual, especially the last few years. The IRS doesn't necessarily say it has to be in person, although we do like it to be. We can usually find more benefit. So the IRS, and this is something that's very overlooked, even from very sharp CPAs. Sometimes they just don't know. They think it has to be a new building or that it has to be commercial. But again, it can be residential or commercial, and it doesn't have to be a new building. I went back as far as 20 years. The owner has owned it for 20 years and depreciated it that long. Now, a lot of the benefits already been taken, but the IRS allows what they call 481A adjustment. It's a one-time change in accounting method. So it actually lets you not have to amend previous returns. And they require that the form 3115 is filled out for this change in accounting method. And we actually provide that. A lot of other cost segregation companies don't provide that. But so how this works is, let's say you've owned a building for 5 or 10 years and you want to do a cost segregation study now. So we can actually get you all of that depreciation you've missed out on, assuming a cost segregation study had been done when you put it into service. So you get all of that in year one. And it's just the difference between what you've already depreciated and what you would have depreciated in those 5 years. So catch-up depreciation is huge. It's very overlooked. And it just gets you more benefit that you could have gotten had you done the study years back. So bonus depreciation has been a huge part of cost segregation the last few years, especially on residential. So bonus depreciation doesn't just apply to cost segregation, but short life property, or occasionally, I mean, depending on if any of you own your own businesses, etc., you can take it on trucks and other types of equipment. But with cost segregation, since we're segregating these components from a longer life down to it being short life tangible property, you can take bonus depreciation on that. And it's been 100% the last few years with the Tax Cuts and Jobs Act. So what that means, even though we're still taking this bucket of 39 or 27 and a half years, we're placing those components into 5, 7, or 15. So these smaller buckets, even though it's still, that's the asset life, or the class, the asset class of those things that we're segregating, you can essentially expense those assets. So with 100% bonus, that just means that you're taking all of that benefit in the current tax year. And so that's set to decrease 20% each year over the next few years. Who knows what Congress will do in the meantime, but it's, if you have someone that's purchased, like, again, any type of building, but especially those in case they have residentials, because you usually don't get the ROI without 100% if it's a smaller property. So bonus depreciation is huge. That, along with the ability to get catch-up depreciation, just makes it even more appealing. So average reclassification of segregated property, it really varies. We have a calculator that, when I go in to do a proposal, I will select what type of building it is, but sometimes I have to adjust the percentages depending on what pictures I may see online, or if I go into Google Maps or Google Earth or the county assessor and what I kind of find out beforehand. I try to do as much research as I can, so we try to underestimate. But these are the percentages that you will typically see when doing cost segregation study on this type of building. So obviously, as I mentioned, warehouses, there's not a lot inside, it's bare bones. You can't segregate the concrete, which is usually unless there's a little office space. But manufacturing can be huge, as I mentioned, grocery stores. We do a lot of apartment buildings. I've had residential rentals where we've segregated up to almost 50%. And then, sometimes they come in at 20%. Those generally are around 30% though. But anyway, I know there's quite a bit of margin there, but it kind of gives you an idea. So some past projects we've done, we've also done, just by name, Sun Valley Amphitheater, Silverado Golf Course in Napa, California. We've done pineapple farms in Hawaii. So sometimes there's not even a building there, but because the land's been graded and it has gravel or asphalt, there's a lot more benefit even in RV parks, more than meets the eye. But here's a pretty good list though. I mean, distilleries, things that are just kind of out of the ordinary, you wouldn't really think of. Marinas, we've done warehouse or airplane hangars in Alaska, marinas. I have some residential rentals in Florida right now that have docks going into the ocean and things like that. So these are some of the commonly segregated items. I mentioned a few things, but like I said, the list is a lot bigger. So if we can kind of skim through some of this, fences, sprinkling systems, sometimes like on a farm, we look for drainage facilities and things like that. I mentioned cabinetry. That's a really big component in a home and sometimes in an office building for like break rooms. So yeah, pretty good list there that you can see. We'll occasionally take certain lighting in a building if it's secondary lighting. If it's the primary lighting for a room, we don't do anything with it. But sometimes if it's if there's a chandelier or again other secondary lighting that the room doesn't necessarily need but has, we'll dig into that, and we actually take a picture of the breaker, so it's all based on amperage as to how that component is supposed to be segregated. So the IRS has in their audit guide 13 principal elements that they want to see in a quality study. It doesn't say you have to be an engineer, it doesn't say you have to be a CPA. Obviously, those things help. We do have a CPA that signs off on every report, and we have people with a construction background, our engineers or experts, our specialists. So it really helps that they understand the tax and the construction side of things. So these are the 13 steps that we follow to make it more of a true engineering study instead of what you would call a thumbnail approach, because there are various ways other companies do these. So the steps to cost segregation, what we usually get is an appraisal, or I'm sorry, depreciation schedule or settlement statement are the kind of things we start out with to start the process of doing a free proposal. So we'll work on proposals as much as we need to without any type of fee. And then we'll eventually, if they decide to move forward, we'll collect some other information depending if it's a new building or if it's already been depreciated, etc. And then we do a site visit. It usually is about a half hour to an hour, depending on how big the building is. If we do it virtually, if it's somewhat of a smaller property, we will have the client download Microsoft Teams and go through a video call with them, and our specialist would be on the other end with a tablet, directing them and marking everything that looks like we can include in the report. And so there are a few other steps here as for when it comes to the costing and preparing the report, but it's usually done within 45 days. As long as we get the site visit set up, it's usually about 2 to 3 weeks after that. And we do hundreds of reports a month. So it's something that we're constantly pushing and doing as thoroughly as possible. RS Means is a cost estimating software that builders use, and that's what we use. So you're not always going to have, most of the time, you're not going to have actual costs because it's not a new building. So with RS Means, we're able to take regional costs. So, a rental in San Diego is not going to cost the same as a rental in Kentucky, for example, just different parts of the country. And it's going to take that into consideration, and also the year it's built, when we actually go back and find the costs and what it would take to do that. Because what we're doing is really reverse engineering the building, recosting it. And so we do a thorough job using the necessary tools. Here's a little bit of numbers for you. I'll try to rush this a little faster. It looks like we have around 10 minutes before we get to some questions. But so this case study is a hotel in Alaska. And this is an instance where they would get catch-up depreciation, which I spoke to. So purchased $8,000, or I'm sorry, $8 million. Purchased in 2011. The current tax year was 2017 when the study was performed. And so there's your numbers. Remember those. I'll show you some of the things that we're able to segregate. We don't usually deal too much with the moldings unless it's super ornate and there's a lot of cost to it, but usually won't mess with that much. But ceiling fans, whether it's a apartment complex or just a single family rental, washers and dryers. I mentioned disposals, fridges, things of that nature. So you're going to get benefit whenever there's something like that. Through the wall AC units, blinds. And then I'll give you one example here because a swimming pool's on here, and not to get too off topic because we're dealing with this one specifically. But my first deal was a multi-use building, and the swimming pool was on the second floor inside. And if I can hear it, ask the question, but I'll just kind of answer it myself. So do you think we could take that swimming pool being on the second floor? Can you remove that without it damaging the building? And the answer is no, you can't. You can't segregate it. So there's a big difference depending sometimes on the nature of the building, the reason why certain assets there, et cetera. But if a swimming pool's outside, it's a land improvement. If it's inside, as part of the building, which many hotels have, you cannot segregate it. So just another example, but you can see some of these other things. It's virtually the majority of the outside of the building. So that's exactly why it comes in good for certain properties like warehouses. So again, that was $8 million purchased in 2011. Current tax year is 2017. So here's your, I have to move my little thing with the videos on it. So year one tax savings was over $1 million on this. And so it's quite substantial what this tool can do for paying, $8,000-$12,000 and then just getting more of your money now instead of paying it to the government. So those numbers speak for themselves, and I'll be able to, I don't know if Abby has this I sent her this presentation, but to send it out to you so you can kind of review that. So benefit in sold properties, you can actually go back 3 years and do a cost segregation study. It's not super common because you need the permission from the new owner, but you can amend if it's within the last 3 years. There's no need to amend, there's no need to amend on when we do the form 3115 for catch-up depreciation. But if you've already filed and it's been sold, you can go back 3 years in an open tax year and do a study on a building you sold. So selling, let's just say that you still own the building and you're wondering what's going to happen when I sell. So there actually can be a lot of benefit. The real property, so again, the section 1250 property, which is the building and land, that's actually what goes up in value, not the decor, the carpet, blinds, etc. It's probably going to be ripped out anyway. So the benefit in selling a building, which is a question mark often, and even a lot of CPAs, if they're not familiar with cost segregation, may not be able to tell you this because they don't know, but it all comes down to the sales price allocation. And this is where the real benefit is if you decide to sell. It depends on how long you own the building. But essentially, when you do the sales price allocation, you don't have to worry about recapture as much, given the fact that you've owned it several years. But how this works, and I have some numbers to show you, it is more of a, I think someone with a really good tax mind or tax eyes can pick it apart a little better, but I'm just going to at least show you the savings on it. What you do, so if you can picture two buckets, so you have your 1250 property. If you do a cost segregation study, it's all in 1250. If you split that out, that section 1245 property, the short life property, is taxed higher. So it's taxed at ordinary income rate. So the goal here, what you do is on the sales price allocation, which we can do for a minimum fee, or a CPA can do it if they know how. But what you do is transfer as much of that gain as possible, you take a deduction in the year of sale, you transfer that gain back to the land and building. That way you're taxed at or capital gains rates instead of ordinary income tax rates. So there's without further ado, you essentially play on the tax rates, on the marginal tax rate. So you're playing on that spread between ordinary income and capital gains rates. So I'll show you just a quick example so I can move on here, but this is definitely an overlooked part of cost segregation. And I know people who have had studies done who were never explained this by the cost segregation group or their CPAs. So you don't have to worry much about the selling price, but if you look up in the top right, cost of property, $3 million. So they owned it for 8 years. You can see here, this is without a study done, section 1250 property. That's where all the cost is. So your tax is $275,000. Well, if you do the sales price allocation a certain way upon sale, and I'm not going to dig into all of the numbers here, but your savings in taxes over 120,000 because of what you've done in this by doing the sales price allocation a certain way. And so it's just, it can actually be more beneficial to end up doing the study where you're getting your tax savings early and saving on the recapture. You can you usually want to leave some of it there, but you can virtually do away with most of the recapture tax. So real quick here. So why cost segregation authority? So we've done over 15,000 studies. I don't know the exact number, but we've had 0 changes on only a handful of audits. So this probably is a question I would imagine. So sorry to answer it early, but the IRS does not just look out. There's not a red flag for cost segregation on its own. But if it's in a return that's being audited, then it's just part of it as normal as anything else would be. So we've only had, I don't know if it's somewhere between 10 to 20 looked at, and we've had 0 changes. So that speaks for itself. Like I say, we have a court case to support everything that we segregate. And we will support it up until court in case it did reach that point. We take an engineering approach. As I mentioned, we provide the depreciation schedule as well. Not all cost segregation groups are going to provide that 3115 or the depreciation schedule. So that's a really important part. Your CPA is just going to charge you more for either of those. So it's already ready just for them to plug into their software. We often generate more benefit, and we bill in full after the report's delivered. We don't need half of it up front. And then we use assessed land value on the county assessor. So we don't just pick whatever land value seems good and comfortable. We often see that where so the IRS sees the county assessor as a safe harbor. So this is what we would need for a quote. I already went through some of that. Depreciation schedule and closing statement are kind of your starting points, and then we just take it from there. I'm just going to speak real briefly, just for the next 2 minutes, on some other energy studies. So 45L is an energy credit. It's more for developers. It's not usually just for like one single home, but or apartment. It's when we have multiple doors to look at. But it's a $2,000 energy efficient credit per unit per door. I just proposed on one, like 14 units in San Diego. It's somewhat of an apartment building, so he would get $2,000 credit, and then our fee on that's around $300 to $400 depending on how many we're doing. This is for whoever has taken out the loan during construction. Usually it's the builder or developer. So these are single family or apartments up to 3 stories above grade. And then it's based on the energy savings comparable to a unit built in 2006. And so that has expired for the moment. We can go back 3 years and you do have to amend, but that's another opportunity. And then you can reach out to me if you have any questions on that. And then just real quick, so that's 45L is on residential or residential or apartments up to 3 stories. If it's an apartment 4 stories or more or commercial, we also do a 179D. It's a tax deduction, so it's not as good as the credit, but it's up to $1.80 per square foot. And that's also based on energy savings. So like the envelope, lighting, HVAC of the building. And we have an engineer that solely does this. He's super swamped because it's very popular. So if you have a need for any of these, feel free to reach out. And I know it's like question time here, so I tried to time that as best I could. So for you or your clients, hopefully you were able to learn something and let me know. I don't know everything. I have questions as well. I'm always learning something, but feel free to let me know if something comes up. So I'm not sure, Abby.
Are there any questions?
I
Vince?
muted most of you, so you'll just have to unmute yourself.
Anything in your chat, Abby?
Nope, but thank you for the great comment, Whitney.
I
Oh,
will.
wait, so Jim said, is it the cost of material that is the number used or the cost of the material and labor, such as a parking lot light pole? The pole is one number, but the cost to get it there would be much higher.
So are you talking more about like the indirect costs?
Go for it, Jim.
Yeah, okay.
Okay.
So I noticed in some of your pictures, like the pool, for instance, is it just the concrete, the gunite?
No, and I'm sorry, that's one of the things that I'll throw out very early on. And so I'm glad that you asked. And I thought maybe I somewhat alluded to it, but no, we are talking about, so when I see a completed report and let's say we've segregated 30%, you'll also see 30%, you'll see the same percentage of the indirect costs, builder's profits, soft costs, architectural fees, et cetera, et cetera. So all those indirect costs, the same percentage gets applied to the concrete, et cetera. So yeah, it's much more than meets the eye, because yeah, we dig into what you can't see that went into building it.
So what about the actual contractor cost, which would probably equal or exceed the material?
Yeah, the contractor costs as well. Contractor costs, and that's all again based on averages based in RS means. Like I say, when we go back 5 years to do, it takes into account the historical adjustment on the cost of those materials at that time as well, along with again architectural fees and builder's profit and so on.
Thanks, Jim.
Any other questions?
I have not received any in the chat besides that, so.
Do you have that slide for the next presentation prepared for the next
No, I
month?
do not. For the tax one, no, I do not have it prepared.
Okay. So first of all, thank you, Robbie, for being here this evening. And
One
for
more
doing...
question.
Yes, Patrice?
How does cost segregation and 1031 exchanges kind of fit together? I mean, do I have to? Go ahead.
Sorry. Yeah, were you finished or? Yeah, we have plenty of people do cost segregation and then a 1031 exchange.
So I'm carrying the entire depreciation. What do you call that? Carry forward to the next property?
Yeah, so there's a safe harbor. I had this question asked the other day. In fact, can't remember, one of the Bluestone Hockley employees had that question because we're doing a 7-plex for him. But there's a 15% safe harbor rule that allows you to, that really benefits you when you're carrying that basis over into another property. And so as long as it's under 15% or 15% or under the short life property, as long as it's 15% or under the total cost of the property, which it is when you throw land back into it, where it typically is. So it's usually not a problem. And you're supposed to exchange into a more expensive property anyway, or the same, there's different rules, but the property of the same value or higher, right? So it usually doesn't affect it. And then we have people that come over from doing a 1031 exchange. I have a few I have to propose on that I just got today that they've done the 1031 exchanges, as long as we have the reduced basis and the right, it's the Form 88, IRS Form 8824, but as long as we have the new basis, we can do it from an exchange into the new building as well. But yeah, it's usually not affected by the study.
So can I do a cost segregation on one building, then 1031 it into another, and then do another cost segregation on that building?
Yes. Yes, you can.
So I'm just rolling it forward.
Exactly. Yeah, but there's a lot of different scenarios that come up. I mean, I didn't get into it, but you know, most of the time a study makes sense. I mean, there's very few that don't go through for one reason or another, but you know, if it's depreciated too long, if the basis just isn't enough, you know, an $80,000 residential rental or a commercial building that's 200,000. I mean, you know, there's kind of these starting points, these thresholds where it makes sense. But even when it comes down to an exchange or a step up in basis, what I'm saying is there's various scenarios depending on you know, what's happened or what you're looking at, you know, whether you're going to sell it or do an exchange, etc. So,
In other words, it's not clear until you look at all the information,
yeah.
basically.
Thank you.
All right.
It looks
ahead.
like John raised his hand if he wants to.
Yeah, I just wanted to add to Patrice's question. The bottom line is it depends on how much basis you have to work with on the replacement property. So when your CPA does a 1031 worksheet, and they can do a rough draft on that, it's all about what you have basis to work with, the net excess depreciable basis and replacement property. That's all I wanted to say. Thanks, everybody.
Yeah,
Thank
again,
you,
that's
Jonathan.
where, you know, your 15% safe harbor comes in. But usually you're going to be exchanging into a more expensive property for the most part.
Thank you. Thank you, both of you. Well, thank you very much, Robbie, for doing a wonderful presentation. We're right on schedule today. Our next presentation will be next month on the
It's March 16th at 4:30,
March
and I'll make
4:30.
sure to get everything put together and sent out to everybody along
gonna
with
be
the
on,
recording and everything.
Thank you, Abby. And it's going to be about tax changes, federal, state, local. So as you're getting your books together for the end of the year and preparing your taxes, you can have a sense for how ugly it's really going to look. Jonathan with Aldrich CPAs is going to be doing the presentation for us. It'll be an extraordinary presentation. There's a lot to learn, unfortunately. And so we're very excited to have him do the presentation for us. Are there any more last questions before do we get everything, Abby?
I think so. Nobody's.
Robbie, we got everything for you?
Yeah, I think so. So yeah, just feel free to reach out with any questions that come up or anything.
Yeah. Don't be afraid. Robbie's very smart. And so thank you very
Thanks,
much for
Robbie.
joining us this evening, and
Yeah,
way to
thank you.
go. Thank you very much.
Thank you, guys. Yeah, and like again, don't hesitate with any questions or comments or anything that I may have even missed or misstated, in case you know better.
All right. Thank you. Good night, everybody.
Thank you.
Bye.
Thank you,
Robbie.
Bye.
Thanks.
Good night.